All right. Hello, everybody. It's Mario from the Montecinos Group, commercial and residential loans. Going to go over some recently funded loans, some fix and flip, and then also DSCR slash bank statement type scenario. So let's jump into it. Okay, so top left here is a single family residence in La Palma, California. The total loan amount was $855,000. This was 90% loan to cost, so that's purchase price plus the rehab budget, which that rehab budget was about 80,000, and then off the after repair value. So after the property's fixed up, we were roughly about 74% loan to value based off that new value there. So once again, this was 10% down for this investor with access to 100% of the 80,000 for a cosmetic cleanup, and this was in La Palma, California for a repeat client that is top tier for getting max leverage and pricing. Next up is another repeat client purchasing. Their strategy is purchasing single family residence luxury, which is an interesting kind of trend that I am seeing a little bit. This individual was self-employed, and on this scenario, we qualified off a bank statement. So it is a business purpose loan because it is an investment property. The property was in Florida, Santa Rosa, Florida, and they purchased the property with private money. This particular loan is a takeout financing that lowered them into the high sixes on 30-year fixed and then 10-year interest only. Both those scenarios will dive a little bit farther in on them on a couple of slides ahead. And last one here is a Los Angeles property in Los Angeles. This is a 4-unit property. The client was coming off a 1031 exchange, selling a property in a different part of California, and basically getting out of that and buying it. I feel like a pretty heavy discount in Los Angeles on a 4-unit property. They ended up wanting to put a little bit more money down. They put about 25% down off the purchase price and rehab budget, and due to the 1031 exchange to have everything lined up there. And we set up 100,000, so about 25,000 per unit to turn the unit for cosmetic upgrades on the property. So let's dive in a little bit more on the fix and flip property in La Palma, California. So purchase price on this was $870, and the down payment was with the rehab budget was right at 11%, and the ARV came in at $1,160,000. So $870 purchase price. The after repair value came in at $1,160,000. So that down payment was about $95,000 to secure that property, and then they can draw on $80,000 there. So that's great leverage. Based pretty much what they're putting down, they're recouping on that rehab budget as they fix up the property. The house is a decent size little house, about 15,760 square feet. Total loan amount was $855. Once again, I always like to stop and okay, so your total loan amount is $855,000. Your purchase price is $870. So that's really good leverage. Which is leveraging responsibly is, okay, is there a value add component, right? Is that property worth significantly more of what you're borrowing? And that's one of the whole premise of why we're able to get to that loan amount, right? We underwrite it. We look at what the property is going to be when it's fixed up. So fixed up, this property is $1,160,000. So my capital partners are comfortable with that, with having a total loan amount of $855,000. The initial loan amount, when you back out the $80,000, is $775,000. And interest-only payments on that are just over $5,000 for the payments to hold on that. So cosmetic flip, the idea is to be in and out within a few months and sell, so to limit the holding time. And that's that fix and flip scenario for an experienced investor. That investor, just kind of give you characteristics, they do have a pretty solid credit score. They're over 700, 704. They are a U.S. citizen. They are self-employed. The cash flows from their own proceeds, and they also have silent partners. They do own property. They were not a first-time investors, and we do not require a general contractor's license for this scenario. So things to note, credit scores, we do go as low as 650, and we can go below as just leverage is significantly lowered, meaning you'll have to have a greater down payment, but not complete end of the world. You can still invest and buy property. Ideally, it's at a 650, 660 range, and you have a lot more options as far as the financing goes. You don't have to be self-employed, but they're self-employed. We do U.S. and non-U.S. citizens. They use cash from a business, and that's another part of private money that makes it the ease of the private money. A lot of traditional financing, you have to have the money seasoned in the account for at least a couple of months. With private money, you don't necessarily need that. You can't have gift donors. I would say it's ideal to have at least 5% of your own account for down payment. Makes things a lot cleaner to go that route. And typically with cosmetics rehabs, you don't need a general contractor's license. If you're going ground up construction or a large, heavy construction budget, they may be a requirement to have a GC. But in this scenario, since it was not required because it was just a cosmetic rehab. Let's see here. The other scenario I was going to go over, which is regarding this property here. So this is in Santa Rosa, California. This middle one right here. The appraisal value came in at 3.4. When they purchased the property, they purchased it for right around 3.175 just a couple months ago. And we ended up going private money on that because of the aggressive purchase price they were negotiating, and they needed to close quickly. So they ended up doing that, and they did a quick, within 45 days, a quick cosmetic kind of little upgrade to the property. The property is already a short-term rental, and it on the appraisal, the market rent survey came in at $26,000. The overall payment, we did a 30-year fix, 10-year interest only, and the overall payment came in around $17,000. So it's pretty interesting. This client's been purchasing luxury single-family residence, and with the option to have a short-term rental. So the revenue on that, the potential revenue, I should say, is really, really good. And I think, they're buying at these properties at a discount right now, right? So securing the property, there's an appreciation play as well in the market. So not only that, the client is self-employed, so is definitely there are some tax purposes for purchasing these luxury SFRs. So it's navigating it with a private money to close quickly, and then taking it out on long-term financing, 30-year fix, where you can land yourself on this scenario was like in the high sixes with a 10-year interest only option. So that was that scenario. If recap kind of what we went over here. So we went over private money rehab loans. We also talked about some bank statement financing and a DSCR. So basically, a DSCR loan is where you get a 30-year fix, and they look at just the income on the property and not require any tax returns or W-2s. Also, if you guys ever wanted to go over your personal scenario, I'd love to hear it. Been in business the last 21 years, and we go over scenarios all day long, and we can give you our advice on what we're looking at and what are some potential ways to finance your next project. So I appreciate you taking the time. We thank you, and look forward to connecting.